Hello, friends. Welcome to another special episode. We try to do data backed studies on various aspects of the market and make some logical conclusions from them. If you recall, we had done this part one of Don't Buy Gold. The title was clickbaity, but inside how uh, different currencies, people in different countries benefited by having gold in their portfolios. And now this is, if you want, you can go and see that video. It was very much appreciated by a lot of folks. I'll put it in the descriptions below. The whole theme of this, trying to maybe avoid gold or not having gold in your portfolio is driven mostly by people not being educated about this asset class and what is its role in the monetary system as an insurance or a hedge in our own portfolio. So this is part two of that same series. Uh, if you look at India markets, I mean, we are currently at all-time highs, and last many years we have been making new highs. Most people are like, why should I even look at any other asset class? If equities is giving me, double-digit returns nicely, why should I even bother to, educate myself or even bother to go ahead and buy any other asset class that, maybe a hedge or a diversification, but I don't see India markets falling. So this is sort of the current mind frame of most people that what is happening in the last many years can continue to happen. So why should I be bothered? But that's not what history teaches us. History teaches us that uh, every now and then there will be a lot of volatility in the markets. That is the nature of the markets, and most portfolios will get hit very sharply once that happens. And gold is obviously often ignored during bull markets because when everything is going right, why would you want to look left? So that's how the situation is right now. But we'll take a case study of two Japanese investors and showcase how gold impacts not just their portfolios but their ways of thinking towards the market. So let's say there are two investors. One investor started in 1990 when Japanese Nikkei was nearer to 37, 38,000. Uh, and that investor had seen 20 years of relentless stock market rise. So this investor probably out of FOMO invested everything here. The if in case you have not followed this, the last 20 years before this peak, Nikkei went up from approximately 1500 to 38,000. So more than 20x kind of gain came through before long consolidation started in the Japanese market. So when people talk about the Japanese example, that what if Japan happens here, what if Japan happens there, also consider what happened before that fall. If in India we get a 20x kind of a rise and then a 20-year downfall, then you can say a Japan has happened here, because this will not happen until this happens in the market. That is also very true. Anyhow, so coming back, one case study is where a investor starts here and another investor was able to time the market bottom, came in 2009 and has ridden the rally here. So we will see how both their journeys are and what is their mental outlook towards market in that journey. So uh, investor A, let's say, says I want a mix of equity and gold. Investor B says long consolidation is over, we'll go 100% equity. Investor B started here. Investor A was smart. He, although he was late to the party, but he was smart enough to know that with this kind of a rally that has already happened, there is a chance of markets going down. So one started with an equity mix, one started purely on equity. Let's see who is right or wrong, or what are their lessons learned. So some data always there. So in the first case, where the case of investor A starting in December 1989, we will see gold versus You'll see the Nikkei 225 versus the gold in Japanese yen, so local currency terms, and versus a portfolio mix of 50-50, how that would perform. And we would sort of monthly rebalance that portfolio. So Nikkei 225 and gold 50-50 monthly rebalanced. So for investor A, if he started in December 1989, had he invested 100% gold, he would have been up 615 or 515%. So 100 would have become 615. Had he just entered the equity and stayed in equity, he would have made nothing virtually. And if he created a balanced portfolio where he was balancing every month between Nikkei and gold, he would have made about 213%. So overall, if he had 100% into equity, zero in gold, his CAGR over 35 years would have been negative, and would have also seen a max drawdown of 80%. I mean, if you live through that, you virtually will hate equities like anything. Even after 10 years of starting, even by 1999, your 100 is already 37, and maybe later by around 2003 your 100 is now 20, and even later maybe the lowest point is here where you hit 80% drawdown, right? If that kind of a exposure, you will start to hate equity, and you will tell your kids never invest in equity, right? Second case, he invested 50-50 in Nikkei and gold. He got a 3.34% CAGR. Nothing great, but didn't lose money. And in a near 0% environment, even 3.34% is all right. Right, and the drawdowns were 57% here, still quite steep drawdowns. And in case he went just with gold, which he did not, the CAGR would have been 5.36%, with a max drawdown of 54%. So this was the outcome for the investor who came in at the very peak of a stock of a market bull run. So in case we were to extrapolate this and say the peak of Nifty for the next many years, how would you think about having your exposure? Would it be 100% in equity? Would it be 100% gold? Would it be 50-50 in gold and equity? Now let's look at investor B. Investor B has been waiting very patiently for market to bottom, and by stroke of luck, he's able to pick the bottom and starts to invest in February 2009. And he's very, very sharp about the fact that he knows bottom is there. He has already ridden this rally, gotten out somewhere here, and he says, now I'm going to ride 100% equity going forward. And if he rides 100% equity going forward, he makes 384% returns. If he mixes it with gold, surprise, surprise, he makes 476 or 376% return. So almost equivalent to what Nikkei made. And if he held only gold, he would have made 290% return. That's the three scenarios that came up. So again, the 100% case where fully he was invested in Nikkei, he made 10.65% return, max drawdown 24. If he did a balanced portfolio with gold, he made 10.53, very, very close to 100%. But just look at this. The max drawdown came down from 24% to just 15%. And if he just did gold, he would have made 9%, not so far actually from here, and 19.8% on the max drawdown. So despite Nikkei going up one way during this phase, gold still added a lot of value, exceptional value, to match the performance of equities while reducing the max drawdown here, right? So lot less volatility, and you can just see this in the graph also, that this gray line that you see here is just smoothly going up. There is hardly any major volatility, whereas in the equity curve you have many sharp falls right here. So this is what the equity curve smoothing looks like when you have mix of gold with it. So different perspective, peace of mind versus returns, if we think about that. So when this phase of, and on the chart it looks easy, you could have lived through this, but just imagine 20 years of living through a drawdown. Just imagine that today, from today onwards, for the next 20 years, you don't find the markets going up. That is this phase. So here in this phase, survival is key. Making money is sort of on the side. You have to survive this somehow, and that survival is possible only when you will buy insurance and hedges to your equity position. And what are the odds that you will dare to touch equity after seeing a 82% drawdown? So if somebody who was watching this would not be able to play this easily because of the fear of this, because of generational, a whole generation has passed where everybody has hated equities. Imagine you came into workforce in 1989, and by 2009 you've never seen gains in your equity portfolio, only losses. Will you ever be able to put any major exposure towards equities? Unlikely, very very unlikely. And hence the contra is also true, because we have seen a lot of gains in the last 20, 30 years. We assume that that same thing will continue to go on forever. It may happen, but it may not happen also. So that is the whole beauty of trying to see it impartially, and not just going based on past experience of the stocks. So someone who has survived this fall by using whatever exposure, insurance, asset allocation, whatever, he or she will realize and understand the importance of peace of mind, even if market is extremely volatile against your position. So gold, of course, is offering that peace of mind. This is just the two difference. What if you bought gold in 1989, and what if you bought Nikkei index in 1989, and the difference is right there in front of you. You can always brush it off saying that Japan is a one-off case, but I can tell you every market will go through these cycles. Maybe Japan was extended too long, and that is also because they went up 20-30x on the higher side also. I mean, 20-30x is crazy. Even from the bottom, like we had Nifty at 7,500 at COVID bottom. Now imagine 20x from there. 1.5 lakhs Nifty. If we go straight from 7,500 to 1.5 lakhs, then yes, maybe a decade will be lost after that, or 2 decades will be lost after that, because you're pricing in I don't know how long ahead. So that is always possible in every asset class, that a bubble formation of gigantic proportions can happen. And once that happens and you are fully you're riding that wave, how do you protect yourself? So gold's low correlation with other asset classes like equities, bonds helps diversify risk. Overall volatility reduces. It's a safe haven asset. So during times of economic uncertainty, which seem to be around us at all times nowadays, geopolitical tension, every other quarter you hear of this potential war-like situation happens. So gold acts as like a safe haven investment and provides stability. Also, gold tends to retain or increase in value during periods of inflation. And the situation that the Fed has brought us in, where either we sustain lower interest rates with high inflation, or we have higher interest rates and collapsing economies. So we are in a fix where you can't raise rates much beyond a certain point and kill inflation, and you can't reduce rates much beyond a point because inflation goes through the roof, because there is so much of liquidity in the system. So this is a sort of a primer on why you should be having gold. And now let's come back to our example of India, where people may be saying that equity is doing very well, why should I invest in gold? Gold gives me 11.7% long term CAGR, Nifty, or maybe my strategy is giving me 20%. Why should I even bother putting 20% into gold? So that is the sort of mindset that comes around when you have been fed with a one way market. I'm not saying at all at any point of time that this is not going to continue, but you also have to be more practical in terms of the possibilities and probabilities of things happening. And since 2000, in the last 24 years, many of you who have not yet followed the gold allocation will be shocked to see that in the last 24 years, gold and Nifty have performed exactly similarly. This one statistic should shake up many of your sleeping brain cells, and just see how gold performs when Nifty is not performing. Nifty down, gold is up. 2008 COVID, Nifty down, gold is up. 2020, 2013 to 2016, sorry, 2015, 16, 17, Nifty down here, gold is up here. Every time Nifty will take a dive, gold in INR will save you there. It is as simple as that. I really can't say more about the importance of this in your portfolios, but definitely do check with your financial advisor if he or she gold for your use case. And if it does not convince you, then don't buy gold. Mat kharido. Thanks. Bye.